Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Marex, senior specialist with index research and development at Nasdaq Investment Intelligence, to discuss the year-to-date performance of the 7 stocks that represent 50% of the Nasdaq 100 index weighting. Mark, it is great to see you as always. Welcome back to Trade Talks, and these really are the heavyweights of the index.
Yeah, Jill, thanks for having me back. Figured we'd bump out our view here from the top 5 to the top 7, given the recent struggles with Facebook, or Meta, as they like to be now called. You can see on this year-to-date performance chart, Facebook, Meta, by far the worst performer here, down almost 35% year-to-date as of yesterday's close. The other 6 here, Microsoft, Apple, Amazon, and Google, really pretty consistently, right, being the largest companies, not just within the Nasdaq 100, but globally speaking as well. They've done pretty well. All of them have been down just a few percent here and there year to date. Microsoft's actually been the worst out of that group, down almost 10%. And then I've added in Tesla and Nvidia as well, which actually have leapfrogged Facebook with its recent severe correction. They've grown larger in market cap, and as a result, as a percentage of the index. And now we find ourselves actually where, talking about the top 7 largest names, we actually have a very representative sample of what half of the index is doing. It makes some math a little bit easier in terms of when you're forecasting, what the impact of these largest constituents is on the index from a performance, from a fundamentals perspective. And that's what I wanted to get into today a little bit in talking about some of these valuations.
Yeah, Mark, it's so interesting. Some of the things that I've noticed in mainstream media, especially this week, has been as goes Apple, as goes the market. So to show those 7 stocks that really make up such a big part of the Nasdaq 100 index, as well as other indexes, I guess the question is, do you see any valuation upside here, considering how important they are to the index?
Yeah, I mean, I think the key thing to keep in mind is, again, these names, with the exception of Facebook, have outperformed the broader index. A lot of the weakness that we've seen in the Nasdaq 100, in the Nasdaq composite, more broadly speaking, right, once you get out of the 100, has been in those kind of smaller and mid-cap areas of tech, and things like biotech that have really suffered in terms of, rates moving up and triggering this sort of spreadsheet recession, or this spreadsheet correction in their valuations. The more of your earnings potential that is far out into the future, the bigger of a hit to the present value of your cash flows when those rates move up in the current environment, right? And that's what we've seen. So, in terms of Apple, not that big of a change in its price. If you look at its revenue growth projections, what we did internally is we looked at kind of consensus street projections for everything from revenue to earnings and everything in between, and kind of arrived at an implied valuation upside based on those kind of consensus fundamental projections. So for something like Apple, that's growing about 5 to 8% a year over the next 5 years, terminal growth rate at 2% when you get to 10 years out. Approximately 70% of its current valuation is attributed to those cash flows that are 5 years out or further. So what we got was an upside of about 13% from current levels on Apple, based on where consensus estimates are around earnings and revenue and all that good stuff.
And Mark, excuse me 1 second here. If we can just pull that chart up one more time so we can show the numbers that you're looking at. Perfect. There we go. Thank you.
Sure. Yeah. So Apple here is actually the one that's most conservative in terms of where we see the growth and the upside from where prices have gone down. They haven't gone down by much. We see about a 13% upside there. The other 3 on this list, you can see a big difference, right? Google, 33% upside, Microsoft, 21%, Amazon, the biggest one, 49% upside. That stock hasn't done very much at all in a little bit over a year. And again, when you look at the growth rates here in the mid to upper teens for the next 5 years, and then settling at, conservatively 1 to 2% as a terminal growth rate, you're getting, 60, 70, 80% of the current valuation represented by those cash flows far out into the future, 5 years or further out. So again, not a surprise that a lot of these names have been under pressure, given how much of their valuation comes from the future, given that they're still growing pretty quickly. But again, I need to emphasize that this is a spreadsheet correction that has been happening in a lot of these very solid fundamental names where the fundamental growth story hasn't changed at all. Just because interest rates have moved up by 100 basis points over the last year, that doesn't really impact Apple's top line or its bottom line. Same for Amazon, same for Google, same for Microsoft. And that's why we're seeing these pretty robust upside projections now that we can make to the valuations, again, using consensus street estimates. So with that, let's go on to the next slide and talk about the rest of this group and sort of what we can imply for the index as a whole. When you look at, Facebook, to round things out, even though it's down a lot, right? It's down over 35% year to date, more than that from its peak. We're only showing a 21% upside from current levels. That's being pretty conservative, I think. For NVIDIA, a stock that has really, really outperformed for several years now, we're showing pretty much no upside, about 2%. And for Tesla, which is really kind of the fastest growing name still out of this 7, with revenue growth up to 55% year over year, forecasted out on a consensus basis in the next 5 years, decelerating to about a 6% terminal growth rate 10 years out. 83% of its valuation is from cash flows 5 years or more out from now. That one hasn't had as big of a hit to its valuation, interestingly enough, right? You would think that with its higher growth and more of its profits sitting out far into the future, that one would have taken more of a hit. It hasn't, I think, because the street recognizes the unique potential that Tesla has to continue stealing market share from a global combustible engine car market. We're seeing an 18% upside on Tesla from current levels based on those projections. When you put it all together and you take the weighted average of these 7 names, it's an 11% upside for this group. So, whether you want to say that that's going to outperform the other 50% of the Nasdaq 100 by a few percentage points, I don't think it's going to outperform by a ton. It may even underperform a little bit, but point is that we do see support for valuations, even at these levels, even after we've come off. It looks like at least 10% off the lows that we were down earlier this month. There's been a nice recovery. And I think, if rates don't move a ton further up, you're going to see some of these valuation upsides start to be realized by people that recognize, look, fundamentally, not that much has changed with the business models of a company like a Tesla or a Google.
All right, Mark, great work as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.